You're watching the news right now, aren't you? Checking your phone every few hours to see what's happening with gold and silver prices, waiting for some talking head on CNBC to tell you it's time to buy. And that's exactly how you're going to miss the biggest wealth transfer of your lifetime. Because here's what nobody's telling you. By the time the mainstream media is screaming about precious metals, the real money has already been made. The institutions have already positioned themselves. The smart money has already moved. And you're left chasing a train that's already left the station. Let me show you what I mean. Think back to March 2020. Remember what happened? The world shut down. Markets crashed. Gold was sitting around $100 an ounce. And what was the news telling you? Cash is king. Stay liquid. Wait for clarity. Classic advice that sounds smart but leaves you broke. But here's what was actually happening behind the scenes. While retail investors were panic selling everything, central banks were quietly accumulating gold at levels we hadn't seen in decades. The World Gold Council reported that central banks bought over 650 tons of gold in 2020, not when gold hit $2,000, not when the news was celebrating new highs. They bought when everyone else was terrified. Fast forward to August 2020, gold hits $2,070. Now the news is excited. Gold breaks records. Is it time to buy? And that's when retail investors finally jumped in, right at the top, because that's what the news does. It tells you the story after it's already happened. The same pattern played out in 2011. Gold spent years climbing from $800 to $1,900. But when did the magazine covers appear? When did your neighbor start asking about gold? September 2011. Right at the peak. Time magazine ran a cover story about gold. That was your signal to sell, not buy. Now let's talk about what's happening right now, because this is where it gets really interesting. Gold just hit new all-time highs above $2,700 an ounce. Silver is pushing toward $35, and the news is starting to pay attention. But they're missing the real story. They're reporting the price movement, but they're not telling you why it's happening or what comes next. Here's what you need to understand. The gold market isn't driven by retail investors watching the news. It's driven by central banks, sovereign wealth funds, and institutional players who move billions of dollars at a time. And these players don't wait for CNBC to give them permission to buy. Look at what China has been doing. For the past 18 months, the People's Bank of China has been buying gold every single month. Not occasionally. Every month. They've added over 300 tons to their reserves, and they're not doing this because they saw a news headline. They're doing this because they understand something about the global monetary system that most people don't. The dollar's dominance is ending. Not tomorrow, not in a dramatic crash, but in a slow, methodical shift that's already underway. The BRICS nations are settling trade in their own currencies. Saudi Arabia is accepting yuan for oil. Central banks worldwide are diversifying away from dollar reserves. And gold is the ultimate neutral reserve asset. But the news won't tell you this is happening until it's already happened. They'll report on it 5 years from now when it's obvious to everyone, when gold is at $5,000 an ounce and silver is at $100. And by then, you'll have missed the entire move. Let me give you another example. In 2008, during the financial crisis, gold was trading around $800 an ounce. The news was focused on bank failures, housing crashes, and stock market carnage. Nobody was talking about gold. It seemed irrelevant compared to the drama unfolding in equities. But smart investors understood something. They knew that the Federal Reserve's response to the crisis would be massive money printing. They knew that quantitative easing would devalue the dollar. They knew that gold would be the beneficiary, so they bought when gold was boring and ignored. What happened next? Gold went from $800 to $1,900 over the next 3 years, a 137% gain while the news was still telling people to stay in cash and wait for the economy to recover. Here's the pattern you need to recognize. The news reports what has already happened. It's backward-looking by nature. By the time something is newsworthy enough to report, the opportunity has already passed. The news is a lagging indicator, not a leading one. Think about how news works. A reporter needs a story. They need an angle. They need something dramatic enough to capture attention. Gold slowly grinding higher from $1,800 to $2,000 over 18 months isn't a story. It's boring. It doesn't generate clicks. But gold jumping $100 in a week? That's a story. That's when they pay attention. And that's exactly when you should be cautious, not excited. because rapid price movements attract attention, and attention attracts retail money, and retail money is usually the last money in before a correction. Now I want to show you something that most people completely miss about the gold market. There are two different markets operating simultaneously. There's the paper market and the physical market, and understanding the difference is crucial. The paper market is where most of the price discovery happens. It's the COMEX futures market, where traders buy and sell contracts representing gold they'll never actually take delivery of. It's a leveraged, speculative market where banks and hedge funds trade massive positions. This is where the news gets its price quotes from. But the physical market is different. This is where actual gold changes hands, where central banks buy, where mints struggle to keep up with demand, where premiums over spot price tell you what's really happening with supply and demand. And here's what's fascinating right now. The paper market and physical market are diverging. You can see it in the premiums. American Gold Eagles are trading at $100 to $150 over spot price. That's not normal. That tells you that physical demand is outstripping supply, even as the paper price suggests everything is orderly. The U.S. Mint has been rationing gold and silver coins to dealers. They can't produce enough to meet demand. Refineries are running at capacity. Delivery times are stretching out. But the news isn't reporting this because it's not dramatic enough. It's just a slow, grinding supply squeeze that's building pressure in the system. Meanwhile, the COMEX is showing something interesting in its delivery data. More contracts are standing for delivery instead of being rolled forward. That means traders are actually taking physical gold instead of just speculating on price. That's unusual. That's a sign that sophisticated players want the metal, not just the exposure. Let me tell you about what happened in 1971 because there's a lesson here that's incredibly relevant today. In August 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. It was called the Nixon shock, and it fundamentally changed the global monetary system. But here's what's interesting. The news at the time treated it as a temporary measure, a short-term fix to address a balance of payments problem. Nobody understood that it was the beginning of a completely new monetary era, an era of pure fiat currency with no gold backing whatsoever. Gold was trading at $35 an ounce when Nixon made that announcement. Over the next 9 years, it went to $850, a 2,400% increase. But the news didn't tell you to buy gold in 1971. They told you the government had everything under control. The people who made fortunes in gold during the 1970s weren't following the news. They were understanding the implications of monetary policy. They saw that removing gold backing meant unlimited money printing was now possible. They understood that inflation would be the inevitable result, and they positioned themselves accordingly. We're in a similar moment right now. The implications of what central banks are doing won't be clear to the mainstream for years. But the signs are everywhere if you know where to look. The Federal Reserve's balance sheet is still sitting at over $7 trillion. That's money that was created out of thin air and injected into the financial system. The European Central Bank, the Bank of Japan, the Bank of England, they've all done the same thing. We're living in an era of unprecedented monetary expansion. And what does that mean for gold? It means that the purchasing power of fiat currencies is being systematically destroyed, not in a hyperinflationary collapse, but in a slow, steady erosion that most people don't notice until it's too late. Your dollar today buys significantly less than it did 5 years ago. You feel it at the grocery store, at the gas pump, in your rent or mortgage payment. But the official inflation numbers tell you it's only 3% or 4%. That disconnect between your lived experience and the official statistics should tell you something about the reliability of government data. Gold doesn't care about official statistics. Gold responds to reality. And the reality is that fiat currencies are losing value, which means gold is gaining value in relative terms. Now, let me address something important. If you're sitting on retirement accounts worth $100,000 or more, you need to understand how gold IRAs work. I've put together a comprehensive guide that covers exactly how to get physical gold into your retirement account without triggering tax penalties. It's in the description below. It walks through the process, the custodians, the storage requirements, everything you need to know. Worth checking out if you're thinking about protecting your retirement savings with precious metals. But back to the bigger picture. Let's talk about what's happening with silver, because silver is even more interesting than gold right now. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. And that dual nature is creating a supply-demand dynamic that most people are completely missing. On the monetary side, silver has been money for thousands of years. It's mentioned in the Bible, in ancient texts, in the founding documents of nations. The word silver and the word for money are the same in many languages. That monetary premium never completely goes away, even in a fiat currency system. But on the industrial side, silver is absolutely critical to modern technology. Solar panels use silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. Electronics, medical devices, water purification. Silver is everywhere in industrial applications. And here's the problem. We're mining less silver now than we were a decade ago. Primary silver mines are declining. Most silver comes as a byproduct of copper, lead, and zinc mining. So silver supply is constrained by the economics of base metal mining, not by silver demand. Meanwhile, demand is exploding. Solar panel installations are growing exponentially. Electric vehicle adoption is accelerating. Industrial demand is at record levels. And on top of that, investment demand is increasing as people wake up to the monetary debasement happening globally. The Silver Institute projects a supply deficit of over 200 million ounces this year. That's the 6th consecutive year of deficits. We're drawing down above-ground inventories, and at some point those inventories run out. But the news isn't talking about this. They'll talk about it when silver is at $75 an ounce, and the shortage is so severe that industrial users are scrambling for supply. By then, the easy money will have been made. Let me tell you about what happened in 2011 with silver, because it's a perfect example of news-driven investing gone wrong. Silver spent months climbing from $20 to $40. It was a steady, powerful move driven by investment demand and concerns about currency debasement. Then in April 2011, silver went parabolic. It shot from $40 to $49 in just a few days. The news went crazy. Silver mania. Is this the new gold rush? Retail investors piled in. Everyone wanted exposure, and that was the top. Silver crashed back to $26 within weeks. The people who bought based on news headlines got destroyed. But the people who had been accumulating silver at $20, $25, $30, they did just fine. They understood the long-term thesis and weren't swayed by short-term price action. The lesson isn't that silver is a bad investment. The lesson is that timing based on news coverage is a terrible strategy. You want to be buying when nobody cares, not when everyone is excited. Right now, silver is in an interesting position. It's broken out of a multi-year consolidation pattern. It's showing relative strength compared to gold. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting around 85. Historically, that ratio averages closer to 60. When it reverts to the mean, silver significantly outperforms gold, but you won't hear about this on the evening news. You'll hear about it when silver is already at $60 and the move is mostly over. Let's talk about what's happening in the mining sector, because this is another area where the news is completely missing the story. Gold and silver mining companies are trading at valuations that make no sense given the current metal prices. Historically, mining stocks trade at a premium to the metal because they offer leveraged exposure. If gold goes up 20%, a well-run mining company's stock might go up 40% or 50% because their profit margins expand dramatically. But right now, many quality mining companies are trading near their lows even as gold hits new highs. Why? Because the market doesn't believe the gold price is sustainable, because investors are skeptical, because the news hasn't validated the move yet. This creates an opportunity. When sentiment shifts, when the news finally starts covering the gold bull market in earnest, mining stocks will explode higher. But by then, they'll already be expensive. Right now, while they're ignored and undervalued, is when you want to be accumulating positions. I'm not going to give you specific stock recommendations. That's not what this is about. But I am telling you that the mining sector is offering value that won't last once mainstream attention arrives. Now let's talk about geopolitics, because this is a massive driver of gold demand that operates completely outside the news cycle. When you see headlines about tensions between the US and China, or conflicts in the Middle East, or trade wars, those are lagging indicators of trends that have been building for years. The de-dollarization movement is real. It's not a conspiracy theory. It's a documented shift in how international trade is being conducted. Countries are tired of being subject to US sanctions. They're tired of having their dollar reserves frozen or seized for political reasons, so they're building alternative systems. The BRICS nations are developing their own payment systems. They're settling trade in local currencies. They're accumulating gold as a neutral reserve asset that can't be weaponized by any single nation. Russia has been very public about this. After sanctions were imposed following the Ukraine situation, Russia dramatically increased its gold reserves. They went from around 1,000 tons to over 2,300 tons. They're not doing this because they love gold. They're doing this because they want reserves that can't be frozen by Western governments. China is doing the same thing, just more quietly. Their official gold reserves are probably significantly higher than reported. They have every incentive to accumulate gold without driving up the price, so they underreport their holdings. India, Turkey, Poland, Hungary, central banks around the world are buying gold at the fastest pace in decades. This isn't a coincidence. This is a coordinated move away from dollar dependence. And what does the news say about this? Not much, because it's a slow-moving trend that doesn't generate dramatic headlines, but it's one of the most important financial developments of our time. Here's another thing the news won't tell you. The gold market is tiny compared to other financial markets. The entire above-ground gold supply is worth around $15 trillion. That sounds like a lot until you compare it to global stock markets at $100 trillion, or global real estate at $300 trillion, or global debt at $300 trillion. What this means is that even a small shift in asset allocation toward gold can have a massive impact on price. If institutional investors decide to move just 2% of their portfolios into gold, that's trillions of dollars of buying pressure hitting a relatively small market. We're starting to see this happen. Pension funds are increasing gold allocations. Sovereign wealth funds are buying. Family offices are diversifying into precious metals. These are massive pools of capital that move slowly but persistently. And they're not waiting for the news to tell them it's okay to buy gold. They're doing their own analysis. They're looking at monetary policy, geopolitical risk, currency debasement, and making allocation decisions based on fundamentals, not headlines. Let me tell you about the COMEX, because understanding how this market works is crucial to understanding gold pricing. The COMEX is where gold futures are traded. It's a paper market where most participants never intend to take physical delivery. They're just speculating on price movements. But here's what's interesting. The COMEX operates on a fractional reserve system. They have far more paper claims on gold than they have physical gold in their vaults. The leverage ratio varies, but it's typically somewhere between 100.1 and 500.1. That means for every ounce of physical gold, there are 100 to 500 ounces of paper claims. This works fine as long as everyone is content to trade paper, but what happens if a significant number of contract holders decide they want physical delivery? The system breaks. There's not enough gold to satisfy all the claims. We saw a glimpse of this in March 2020 when the gold futures market experienced a delivery squeeze. The spread between futures prices and physical prices blew out to unprecedented levels. It was a warning sign that the paper market and physical market were disconnecting. That disconnect is growing. Premiums on physical gold are elevated. Delivery times are extended. Refineries are at capacity. These are all signs of stress in the physical market that the paper price isn't fully reflecting. When this tension resolves, it's going to resolve higher, much higher, because the paper price will have to rise to reflect the reality of physical scarcity. But the news won't report on COMEX mechanics or delivery squeezes until there's a crisis. They'll tell you about it after the fact, when gold has already spiked and the opportunity has passed. Let's talk about inflation for a moment, because this is where most people get confused. The official inflation numbers say we're at 3% or 4%, but your lived experience tells you it's much higher. Your grocery bill has doubled. Your rent has increased 30%. Your insurance premiums are through the roof. So which is right? The official numbers or your experience? Your experience is right. The official numbers are manipulated through methodological changes that understate real inflation. They use hedonic adjustments, substitution effects, and geometric weighting to make inflation appear lower than it actually is. Why does this matter for gold? Because gold is the ultimate inflation hedge. Not the inflation the government reports, but the real inflation you experience in your daily life. When the purchasing power of your currency is being destroyed at 10% or 15% per year, holding cash is a guaranteed way to lose wealth. You need assets that maintain purchasing power. Real estate, stocks, commodities, and especially gold and silver. Gold has maintained its purchasing power for thousands of years. An ounce of gold bought a fine suit in Roman times. It buys a fine suit today. That's the definition of a store of value. But the news won't frame it this way. They'll talk about gold as a speculative investment, not as insurance against currency debasement. They'll compare gold returns to stock returns and make it seem like gold is underperforming. That's the wrong framework. Gold isn't supposed to outperform stocks in a bull market. Gold is supposed to preserve wealth when everything else is falling apart. It's insurance, not speculation. And right now, with the amount of debt in the global system, with the money printing that's already happened and the money printing that's inevitable in the next crisis, you need that insurance more than ever. Think about the math for a second. The U.S. national debt is over $36 trillion. That's trillion with a T. The interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense. How do you service that debt? You can't tax your way out of it. You can't grow your way out of it. The only option is to inflate your way out of it. Print more money, devalue the currency, and make the debt easier to service in nominal terms. This is what every heavily indebted nation in history has done. And it's what the U.S. will do. Not because they want to, but because they have no other choice. And when they do, gold will be the beneficiary. Not because gold is going up, but because the dollar is going down. Gold isn't rising in value. It's maintaining its value while the currency loses purchasing power. The news will eventually figure this out. They'll run stories about the gold bull market and the dollar crisis. But by then, gold will be at $5,000 or $7,000 an ounce, and you'll have missed the move. Here's what you need to understand about market cycles. Bull markets don't move in straight lines. They move in waves. There are periods of rapid appreciation followed by consolidations and pullbacks. The news only pays attention during the rapid appreciation phases. Gold has been in a bull market since 2001. It went from $250 to $1,900 by 2011. Then it consolidated for a decade, bottoming around $1,050 in 2015. Now it's in the next leg higher, breaking out to new all-time highs. But most people don't see it as a bull market because they're focused on the short-term noise. They see the consolidation periods as bear markets. They get shaken out during the pullbacks. They miss the bigger picture. The bigger picture is that gold is in a secular bull market driven by monetary debasement, geopolitical instability, and the decline of dollar hegemony. These are multi-decade trends that don't reverse quickly. Understanding this allows you to ignore the news and focus on the fundamentals. It allows you to buy during consolidations instead of panicking. It allows you to hold through volatility instead of selling at the bottom. The news will never give you this perspective. They're focused on daily price movements and short-term narratives. They can't see the forest for the trees. Let me give you one final example that ties this all together. In 1980, gold hit $850 an ounce. That was the peak of the last great gold bull market. The news was everywhere. Magazine covers, TV specials, everyone talking about gold. And that was the signal to sell. Gold then entered a 20-year bear market, bottoming at $250 in 2001. The people who bought at the top based on news coverage lost 70% of their investment. But the people who bought in the 1970s, before the news was paying attention, made fortunes. They understood the fundamentals. They saw the inflation coming. They positioned themselves early. That's the lesson. Don't let the news tell you when to buy. By the time they're telling you, it's too late. The smart money has already moved. The opportunity has already passed. Right now, we're in the early stages of the next great gold and silver bull market. The fundamentals are in place. Central banks are buying. Supply is constrained. Monetary debasement is accelerating. Geopolitical tensions are rising. But the news isn't excited yet. They're not running cover stories. Your neighbors aren't asking you about gold. That's your signal. That's when you want to be accumulating. When the news finally catches on. When gold is at $5,000 and silver is at $150. When everyone is talking about precious metals. That's when you'll be glad you didn't wait for permission. That's when you'll understand that the best time to buy is when nobody cares, not when everyone is excited. The choice is yours. You can wait for the news to validate your decision and miss the opportunity. Or you can do your own research, understand the fundamentals, and position yourself before the crowd arrives. Because in markets, the crowd is always late. And late means expensive. Don't let the news make you part of the crowd.